What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Chris VanDeWeert. How are you doing today, Chris?
Doing very well. Good to see you, Dan.
Awesome. And I didn't butcher your last name, did I?
You nailed it, actually.
Yes. Onyx
First
for the
try.
win. All right, good stuff. And I got some even better news for you, Chris. I don't know if you're aware of this or not, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, investors, buyers, sellers, operators, all that kind of stuff. And you may ask yourself, why would you do that? And the answer is, if you've ever heard of an off-market private deal that you're not allowed to publicly discuss, then you should know that the SEC requires that you have documentation of your prior substantive relationship, or else they'll get ants in their pants when they audit you, and they'll basically shut you down. And that's no fun at all. But on top of that, the benefit for you for watching these episodes is you will learn to effectively communicate on the subject of commercial real estate deals, and in the process, you'll understand how my guest fits into those deals. But before we talk too much about real estate, Chris, do you want to say a thing or two about yourself?
Yeah, for sure. So I'm a commercial real estate investor based in the DC area in Northern Virginia, but I invest mainly in the Southeast and Midwest, and excited to connect.
All right, awesome, awesome. And the first segment that we do here, it's the five distinct motivations. But before we do that, I got to say, but wait, check your eight. And Chris, I don't know if you know technology to this degree or not, but maybe you can see through the camera and down into the user's device. There might be down there this hideous subscribe button down there, and they might want to do something about it's ugly. Okay, it's a stupid joke, but whatever. We really got to get more subscribers. That's the skinny. But let's talk about motivations. The five distinct motivations, of course, everybody has their own unique why. And I've now interviewed over 300 different investors and syndicators and whatnot. And so you keep on getting these different answers for what exactly keeps them in the business. But the reason why we need to know what that motivation is because these deals take months to close. They take years to go full cycle. So you really need to know before you start doing business with each other, what's going to keep you from throwing in the towel. And there's plenty of reason to do that. But at the same time, I find that all these unique whys, they fit pretty neatly into these five different distinct motivations. And let's go through them. The first one of the bunch is preservation of purchasing power. What on earth is that? Some people, they don't have to have a job to pay their bills. So the way that they do that is because they own a portfolio of assets, and the proceeds of ownership are how those bills are paid. Now, of course, when you're in that situation where you don't need to work, you might think it's like, well, why would they go through the hassle of another acquisition? Well, there's two scenarios that are most likely for that. The first one is when inflation is rearing its ugly head. That's going to be eating away from the purchasing power of the cash flow. So it's going to be time to make a new acquisition. The other situation is when there is deep distress or an asset crash, so you can buy at a very steep discount. And of course, everybody should be buying at a steep discount as much as humanly possible. But if you are in this situation, you're not going to pull the trigger until it's a very good deal. And you're not going to need to make a deal every single year, every few months, or anything like that. Now, I'm not to this point in my commercial real estate career. What describes me better is trading time directly for wealth. And that is because I got a background in technology. And of course, anybody who has a background in something that's high wage, high salary earning, you probably are aware of the fact that your tax bill is a lot higher than anybody else's. And That became particularly obvious to me when I started working in 2014, doing the CRM agency work that I already had started from 2011. I started doing it for a real estate firm in Ohio that was doing 10 single family house transactions every month. So basically flipping 10 houses a month. And when I saw the earning potential that my boss had tapped into, and then also the tax advantages, what hit me was I have to pivot to where I'm getting rewarded for my effort in the form of deployed capital, these little slivers of equity, instead of seeking an ever increasing salary and paying more and more in tax. So that's what I'm up to. That's my motivation. But I understand that, especially for young people, that's a little too abstract. So the more common answer for why they're involved is they want to hustle like crazy for now, and they want to fast track their retirement. Now, of course, that's just one form of a bigger idea, which is taking control of your schedule. Basically, working fewer months per year, fewer weeks per month, or something like that. Just having more options, maybe more time with your family, things like that. That is really key for some people getting into this industry. Now, one of the things to keep in mind, though, is that a lot of the people who have this as their main motivation, they'll believe that secretly everybody wants to retire, everybody wants to stop working. But I assure you that is simply not the case. Frequently, you'll find people in this industry that are fueled by ambition. They want to buy their entire hometown. They want that generational wealth. They want to make sure that their great grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. And even though that is vilified in some circles, the fact is, if you want to make sure that these places, these buildings are kept in great condition, that people are happy to live there, you need somebody who is constantly motivated to keep going. So I don't think it's really earned that bad reputation. Now, of course, maybe the reason why they got a bad reputation or sometimes vilified is because they focus on their own family. Whereas this last group, they've picked a sector of society, or maybe it's the environment, maybe it's animals, something like that. But the important thing is they've realized that there's a financial component to making a big impact. And that's why they're making these commercial acquisitions. It's to make that financial difference so they can really make the change that they want to see in the world. So Chris, those 5 different motivations, what combination of them would you say describes you best?
Yeah, I think that's a really good question because it is a combination for me. Fast track for retirement. I've done the W-2 sales gig for 17 years and definitely wanted to get off of the hamster wheel. So that's a motivation for me. But that's not just the sole reason. The why, my big, powerful why, is to spend more time with my family. I'm super close with both sides of my family. And I had my brother and his family here locally in the DC area. He's a active duty officer in the Air Force and just got moved to Texas. So I'm missing them quite a bit, and everything I do every day, especially as it pertains, excuse me, to my real estate business, is to spend more time with my family. And of course, the charitable causes that I'm passionate about as well. That last piece that you mentioned, that's a really big factor for me in leaving a legacy rather than just building my own personal wealth. Which is important for me and my family. But I want to leave a lasting legacy that makes an impact for when I'm gone as well.
I love that answer. And honestly, I don't think anybody should be shy or coy about it whatsoever. Like, it's like that's really the reason why we do everything we do is for our families. And very few of us actually are able to spend the amount of time with their kids that they'd like. And, you know, me, I've been working from home since 2011, which is my children's entire lives. So I am so fortunate for that exact reason that any price would absolutely be worth it. So I love that answer, and I love supporting people who are willing to come out and say, it's like, listen, I haven't had enough time with my family, and that's what I'd really like if it's at all possible. So good on you. But of course, when we're talking about motivations, it's really easy to sound overly optimistic, even sometimes to the point of sounding naive. But if you've ever been involved in one of these private off-market deals, these 506B syndications, then whoever the securities attorney in the mix was, and there better have been one, or else that's the biggest red flag there is. You should be running away. Huge chance that it's just a Ponzi Ponzi scheme. You have to register anything that's passive, involves passive investment. But anyway, the securities attorney should have insisted that every partner, every person who's involved in the deal fills out this super invasive financial questionnaire. It's often called a suitability questionnaire, asking all sorts of questions like what's your net worth and all that kind of stuff that nobody's really comfortable talking about. But when I was going through that questionnaire, there was one part of it that I thought it didn't really have much utility. It didn't give an actionable answer just the way that it was phrased. So I made my own version, and it's this tolerance for risk assessment question. And it's a fill in the blanks. There are many popular investment asset classes, but I think blank is too risky. So Chris, it can be inside real estate, it can be outside real estate, it could be both if you want. What's too risky for you to invest in?
Yeah. Do you remember? All right, this might be out of left field. Remember NFTs?
Mm-hmm.
I know it's not a popular asset class. Well, it was it for a flash in the pan moment, right?
It sure
Uh,
was.
yeah, yeah. I had some friends who were really into it. I think it was kind of during the pandemic when everybody was kind of at home, had some extra time on their hands, and really wanted to trade this new hot thing, right?
Yeah.
I got into the game a little bit just because I was interested and wanted to try it out. But yeah, you get if you're the last person holding it, you're kind of stuck with the bag, right? So I'm not into the speculative, type of investments in that realm. I'm pretty conservative when it comes to my own stuff, my own personal investments as well, and I take that same mindset into handling my clients' hard-earned money as well.
I love that answer because like all the different types of crypto and NFTs, it's an appreciation move. It's buy low, sell high, or lose. Full stop. In commercial real estate, you need more ways to offset the risk that you're taking on. So I love that answer. But of course, at the risk of sounding too nerdy, I got to talk about this next slide here. For the first few hundred chance encounter interviews, I didn't include this one, even though I really, really wanted to. The reason I didn't include it is because some people are really in the public relations or the front of house sort of role, the marketing roles in a commercial real estate deal. So they're not going to be the people who really hinge their bets based on the different deal metrics, the different things that the underwriting can project. But even if you are just the front of house type of person, you are going to be picking like a top 3 deal metrics or something like that to really explain the benefits of whatever you're into. And I want to make sure that you can speak the language of whoever my guest is and picking on those same metrics. And anybody in the audience who is just listening and not watching, I'll read out the 14 different metrics that I have here. It's not an exhaustive list. Some people focus on 1 or 2 other metrics that aren't on here, but it's a really good start. And here we go. The first one is cash on cash. Next is IRR, internal rate of return. Then there's cost per door. Then there's net operating income, which is NOI, then the going in cap rate, which is actually talking about what sort of discount are you able to buy at compared to the area where you're buying, because there's always a standard cap rate or going rate for that. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan. Then there's the occupancy, which is the inverse of vacancy. So it's the same number, but just inverse. Next one is the average income where the property is located, then the amortization period of the loan, which especially is important if you're assuming a loan. Then there's the difference between the market versus the in-place rents. Then there's the population growth where the property is located to have that baked in demand or an appreciation force in there. Then there's the sponsor record, which is how many deals have already gone full cycle, how many deals are on the go right now. Then there's waterfall split or exit strategy, which is what happens to your investment after your capital has been returned. And then there's DSCR, which is debt service coverage ratio, which is how much of the revenue from rent is going out the door immediately just to pay for the loan. So once again, that's not an exhaustive list, so you're more than welcome to add one that's not on there. But Chris, maybe you can give like a top 3 or something like that.
Yeah. I was thinking that actually a top 3. I mean, IRR is something that I think is really important for investors to keep an eye on because that can track across multiple investment classes. So it's a great way to compare what the real estate deal that you're interested in can do for you in terms of how it compares against maybe your stock portfolio, your mutual funds, a bond, that sort of thing. So it can kind of go across asset classes. So that's probably my top one. Multiple is another one that's kind of baked into this list a little bit, but not specifically called out. But that's one that I know a lot of my investors and myself included in my own personal investing are really interested in is that appreciation factor and what the total deal, what am I getting right over the next 3 to 5, 7 years out of this particular deal. And if someone is more interested in current cash flow, the cash on cash is another huge important metric. What am I getting? What's my mailbox money, right? And those tend to be folks who are more interested in current income versus the long-term more appreciation play.
I love that answer. I love that answer. I'm eating it up like a delicious subscribe sandwich. It's very subtle, but it's the way to remind me it's time to pull out the Dan Does Deals Commercial Core Competency Cube, which has the 6 different roles in a commercial real estate deal. And the reason I go through it in every episode, it only takes a couple minutes, it's because if you know the different roles in a commercial real estate deal, then you'll understand how my guest fits into those deals. But more importantly, it's the real tool that will help you effectively communicate on the subject of these deals and easily spot what's missing in a team. That's been a big thing in the news over the last couple of years. The different properties that are under bigger distress, they were missing things like boots on the ground. But if you look at this cube and you say to yourself, wow, I really need me one of those. Well, the good news is it's absolutely free. You can go to dandoesdeals.com and there's this great big button you can click on and print it out and save it, all that kind of fun stuff. And that's exactly what I want you to do, which is why I committed the cardinal sin of marketing. You should always ask for some sort of contact information in return for your freebie. But I didn't do that because I really think that your future in this industry is going to hinge on your ability to effectively communicate. So let's start talking about these different roles, starting with the most visible one, the one that you're more likely to meet than anybody else in a commercial real estate deal, which is a repositioner. It's an acquisitions person. In order to be an acquisitions person, to be good at it, you need to look at hundreds of different deals, and you have to do a whole whack of paperwork. The paperwork is called underwriting. That's where you're making your projections and mitigating the different risks involved. The first thing involved is you have to do the math to find out, is this seller or broker even telling the truth about how much the property is making? Because okay, so that's what they have to be able to do. But the real reason why the repositioner is doing the underwriting is because they are searching for upside. They have to find a way to make the property more profitable than it is right now. And the most peculiar part of being a repositioner is you have to have extensive financier relations, okay? The investor relations, the lenders, the banks, all that kind of stuff. You need to know tons of people who only work with paper, money, and the owners of these businesses. The reason is because if you can secure a more advantageous loan, that goes straight to the profitability of the business. So they're always on a search for cheaper money and people who are not on the GP team, but they're just going to contribute capital, and that's it. Now, the next place that the repositioner is going to look to find that upside is make those operations more efficient. And the idea is that it's more than just, making sure those Benjamins don't go down the toilet. It's also making sure, like the collecting of rents, mowing lawns, shoveling snow if you live where I live. But the contributions I make to a GP team when I'm on it, there's a few of them. One is the digital side, which is any sort of website or web application or social media, something like that. I'll take care of that. But the bigger one to understand, especially because of the nature of my work, I tend to focus on deals where it's 100 units or more. And frequently those are the ones where you outsource your operations to a third party. So the question might be, how could a guy like me be any help whatsoever? And the answer is, even if you're outsourcing your property management to a third company, party, you have to understand that vacancy is the real deal killer. So somebody on the GP team needs to have some serious marketing chops to make sure that those units are filled so that everybody gets the returns that you're projecting. So that's how I contribute to an operations team. And then, of course, we were talking about deal metrics a moment ago. That's also how I'm able to focus on IRR instead of cash on cash to be more inviting to deal sponsors, because that's what I'm up to. But there's only so much you can do to make operations more efficient as a repositioner. So the next place you're going to look is to get a contractor team involved to make the property nicer. If you upgrade the units, there's a good chance that the next residents will be happy to pay more in rent than the previous ones. So there's your upside. But if only it were that simple, you could spend endless amounts of money on contractors, and you could even gold plate the toilets if that's your thing, but you're not going to get a decent return on your investment. And so you need somebody else to help it out. And I don't know if you know this about me personally, but I'm from the internet. And that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because that will not be me. I'd still be stuck at an airport in an hour or two. So I need somebody who can be there fast, keeping an eye on the contractors, make sure they're not using subpar materials, making sure they're not dragging their heels. And then, of course, making sure that the operations team, they're not basically faking photos or, basically misrepresenting the condition of the building. But when it comes to the deal itself, let's say you decide to be a deal maker. Maybe you're an engineer or an attorney or a physician, and you realize, hey, I know how to buy a house. I just put down my down payment and then I borrow the rest from the bank. So maybe if my friends and I, we put in like 100K from our 401k or something like that, or self-directed IRA, if we each pool our resources, I bet we could take that 350 unit apartment complex down the street over and support our local economy. So you get the property under a contract, you turn around to the financiers and say, hey, I got this 350 unit apartment complex. It's going to be amazing. It's the low price of tens of millions of dollars. You don't have, say tens of millions of dollars you want to lend us, do you? Well, there's a problem with this little hypothetical that I haven't mentioned. And if you're in a guru program or a mentorship program, something like that, I highly encourage you to listen carefully to this next part, because the financiers are going to ask you, who's your sponsor? Who's your KP, your key principal? What's that all about? See, the banks, when they give you that commercial loan, they have to make sure that you're not going to use their depositors' money and then run the business into the ground. So they need somebody in the fold who already owns a similar asset. So in other words, you're not going to get a commercial loan for a 350 unit apartment complex unless somebody in the fold already owns a 350 unit apartment complex. Now, on top of that, you need a certain amount of liquidity. And then among the ownership team, the GP team, you need enough collateral, in other words, a balance sheet of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Chris, as far as these different roles in the different deals, what boxes are you most likely to check on your next deal?
Yeah, as an owner of a small business myself, I wear a lot of different hats. So, but you also want to be, focused on your strong skill sets, right? And mine happens to be on that repositioner side, building those relationships, those key relationships to find the deals, broker relationships, financier relationships as well, KPs to bring on board once you've got that deal. So I think it's important to focus on, what you're strong at. And I know my strong sets, networking, relationship building, and making sure that the numbers are solid and conservative underwriting as well. I think that's really key and where I focus the majority of my time.
Mm-hmm. All right. I love that answer. So then let's talk about the assets themselves, the buy box, the ideal properties. So now that I've spoken to all of these different players in commercial real estate, one thing that is very important to share with each other, and sometimes I forget, is, hey, what you looking for? What's ideal? And when we're asking about what you're looking for, we're really asking about three main things. First one's geography. Where is it? Which state, which county, which neighborhood? Okay, it's all can be very, very important before they call it ideal. The second one's size. Now, most of the guests that I have on this show are in multifamily, and the way that you define size in an apartment complex is by the number of apartment units. And of course, that's part of the strategy baked in. It's, you've got multiple revenue sources for the property as opposed to a single family where it's just one revenue source for that massive investment. So that way you're mitigating a bit of risk right there. But the reason why we need to share the size is because the type of group that's going to be taking over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the ones that are taking over 150, 350 unit apartment complexes. So that size definitely matters. And of course, there are other forms of commercial real estate that go off of acreage or square footage, but that issue of size still applies for the same reason. Now, the third thing, though, is frequently called class. I'm not a fan of that term because it sounds like it's one thing and it's actually two. I prefer the term desirability. And those two things that are the separate parts of desirability are condition and area. So if you're talking about condition, it's how old is the building, how beat up is the property, what sort of luxuries and amenities are there? Is it a really no frills sort of place, or is it a place that has all kinds of wild stuff in it? Okay, that's the desirability of the condition. But if you're talking about the area, because it's often residential, the investors that I talk to on this show, then the school district where the property is located is going to be relevant. But regardless of the type of real estate, the crime rate is going to be very important. And then, of course, there's that old broker trope of location, location, location. I don't like that saying because I don't think it teaches much. I think what they really mean is traffic, traffic, traffic. If a gazillion people are passing by a property every single day, it's going to have more desirability baked in. But both the area and the condition, the way you rank them, it's the same as in grade school where you have A plus at the top, then it's A, then A minus and B plus and so on. So Chris, as far as those three parts of the buy box, what's easier to say yes to for your group?
Yeah, our buy box is 50 units plus. Tends to be Class B, Class C in Class B, Class A, Class B neighborhoods, right? So we're looking for that diamond in the rough as repositioning the asset, which just simply means adding value. Like you mentioned, fixing up the units, renovating them, making them look nicer, attracting tenants that are willing to pay those higher rents in those attractive neighborhoods. Path of progress is a term that gets thrown out there a lot, right? But it's really important to find those neighborhoods where people want to move and where jobs are growing, industries popping up, businesses are popping up. Those are really big for me. So yeah, 50 units plus tends to be also where the management piece, that property management piece, really becomes more affordable when it comes to the bottom line for the deal getting done as well.
Great. And then as far as states go, which focus?
Yeah, so I mentioned Midwest and Southeast earlier, but specifically Ohio and Michigan in the Midwest, and on the Southeast side, here locally in Virginia, Richmond, Virginia is just close by me. So that's just one that I'm keyed in on specifically. But the Carolinas are a big focus of mine as well. Charlotte, Greensboro in North Carolina, and then Greenville, just south of Charlotte in South Carolina as well. Those are areas that I'm very familiar with.
All right, I love it. And so then that brings us to people. And my favorite part by far of coming into commercial real estate, especially from tech, in tech, people tend to be pretty guarded and private and whatnot. Whereas people in commercial real estate, I think it's because it's multifaceted. You have these 6 different roles and nobody is going to be all 6 roles for any meaningful amount of time. Instead, they're going to hunker down on a couple different parts of the puzzle and really knock those out of the park. So even though we're always eager to give new introductions, new referrals, even to teams that we're not even going to be a part of, we still, because of our unique skill set, are better off helping some people than others. Me personally, because of my tech background, marketing and all that kind of digital mumbo jumbo, the sponsors and KPs are the people who I generally am most eager to speak to. Everybody is ultimately in the business of deploying capital. So that's, meeting more financiers is important. And then in the context of this interview series, which is where I'm trying to build a much stronger, more cohesive community of people who actually take compliance somewhat seriously, that's I'm always eager to talk to anybody on the die. But Chris, if you have any 506B deals going on right now, make sure you don't mention them specifically while you're saying that you're interested in meeting more investors or financiers. But who on the cube are you most likely to, who can you help disproportionately more?
Yeah, right in line with what you just mentioned, Dan. The KPs and the financiers side specifically, those are obviously vital to the deal. Nothing gets off the ground without those particular pieces on board first. And that's where I focus my time, building those relationships with those key folks.
All right, perfect. And so then people must be thinking, how on earth do I reach out? And I'm going to sandbag that real quick by talking about myself. So I have this super distinctive Dutch last name, which sure looks like Chris's origin as well. But that benefit of having the distinct last name is it makes it really easy to find me on LinkedIn, which is where I spend most of my social media time. Other than that, if you do hit up Amazon.com, I have some different books available on different professional skill building type things, including real estate syndication. But if you are going to be involved in investments or syndications, I do highly encourage you to, you can pause the video if you want. You can scan this QR code with your phone. That goes to the FAQs page of 506BME, which is the platform where I took all of that CRM agency experience and distilled it down into what's the most valuable thing that I can offer people, and make sure that you have that documentation of your substantive relationships, because the SEC absolutely will shut you down if you don't have that documentation in place. And even if your laptop fell in the bathtub, that's not going to be a good enough reason to the SEC to not have that documentation. They're going to assume that you didn't actually know people and you publicly solicited them, and that is enough reason for them to shut you down. So that's what I have on offer for you. But Chris, I know that our paths crossed on LinkedIn, so I imagine that's a pretty good spot. But website, phone, email, social media, how should people reach out?
Yeah, I'll point you to my LinkedIn. That's where I also spend the majority of my time, and get to interact with amazing folks like yourself, as well as folks interested in these types of deals. So yeah, I think probably the only VanDeWeert that I know of, at least in my family, that's active on LinkedIn. So that's the best place to reach me as well.
Yeah, I don't know if it's a Dutch thing or what or not, but yeah, it's one of those things. It's just waking up to the future. And speaking of the future, the last part here I've got is my public service announcement. So it's not specifically for you, Chris. It is. If you've been watching this episode and experiencing like searing pains in your eyeballs, like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that's just down there, and you can get rid of it for free. Now, full disclosure, I want people to click on the subscribe button just because if enough people do, then YouTube will start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, just so we're clear, again, it's completely free, but it does mean that my videos may show up on your list of suggestions. But quite frankly, you could go ahead and ignore those suggestions. I just really appreciate the fact that you spent this time with me. Just like Chris, I appreciate you joining me today. This has been great.
Thank you so much. Really appreciate the opportunity. Pleasure getting to meet you and get to chat.
Hey there.
Awesome.
Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions.
based on your core competencies you look to contribute, your level of sophistication, and all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.